Hey, good morning, everyone. Marty Mazzora here. Friday, 9th of December, 2022. Going to do a quick economic update for you. And we're going to look at the stock market. And we're also going to take a look at the dollar and a quick look at treasury bonds. And I want to talk about what you look for technically in related asset classes based on how they've been trading relative to stocks to maybe get a feel for direction, particularly at a time like this when the stock market technicals, at least on a short-term basis, are giving you a pretty ambiguous look. But before we get there, let's talk about the economy. We dipped again this week, another point, which brings our score down to a minus 20. And that just continues to confirm our feel and our assessment that we are going to see a recession next year. Looking at the inputs that I picked for today, we thought we'd take a look first at retail sales, although the primary numbers that people look at aren't out yet for November. But the Redbook retail sales numbers are, and this is a weekly look. They track the year-over-year change among major retailers, and I like it. It's more high frequency. And as you can see, on a rate of change basis, right, that's been dropping, quite notably. So up 5.7% year over year. And you could say, well, that's not bad. Well, no, it's not, except when inflation is running at, 6 or 7%, then you know that retail sales on a volume basis are actually declining. And as you can see again, that even though we're getting into shopping season here in the November numbers, in terms of annualized growth, has been contracting here. So not a great look as it relates to the U.S. economy. Consumer confidence, University of Michigan's, that was released this morning, and we actually got an uptick there. Getting into the particulars a bit, confidence rose, as you can see, to 59.1. That's the headline reading. It was 56.8 last time, and it was 2 points better than forecast. Current conditions and expectations were actually up month over month. One-year inflation expectations were down by 0.3 to 4.6, and that's due to gas prices, I'd say largely. The 5 to 10-year outlook held at 3.0% annually. Plans to buy a major appliance actually rose by 4 points. Those who said it's a good time to buy a car or a truck was up 3 points after falling by 7 points last month. Those who want to buy a home increased by 3 points, but that's after dropping by 10 points in November. There were more notable gains in confidence for higher income families, according to the report, and those with large stock holdings supported by recent rises in financial markets. On inflation, throughout the survey, concerns over high prices, which remain high relative to just prior to this current inflationary episode, have eased modestly. Okay, and that kind of comports with what Chairman Powell talked about last week, or at least his tone last week when he spoke at the Brookings Institution. I wrote a little bit about that this morning, or I shared with you my log entry yesterday, and speculated a little bit maybe about what he may come out and say, or what his tone may be when he has his post-meeting press conference next Wednesday. But as I titled this morning's written blog post, the short-term setup is virtually a toss-up right here. And we'll get more into that when we get into the technicals. Initial jobless claims ticked up a bit. And again, ironically, that would be bad news, but it's good news for the stock market, the way it's been trading of late, because what it says about conditions and inflation. And the continuing claims are actually up for the 10th straight week. So definitely seeing some softening here in the labor market. Not huge yet, still looks pretty tight. Again, wage increases, wage growth is there. In fact, some other related data came out this week that had to do with job switchers are seeing like 8% increases in their wages when they switch jobs. So that's inflationary stuff, and it's sticky, meaning wages don't necessarily go down when things begin to slow down, or at least not to the extent that other things might. Wrote this week about the ISM services survey really decoupling in direction from the manufacturing survey, which is now in recessionary territory. What's that all about? Well, reading from the report, increased capacity and shorter lead times have resulted in a continued improvement in supply chain and logistics performance. A new fiscal period and the holiday season contributed to stronger business activity and increased employment. Now, readers of the blog recall that the other day I wrote about this, but I also included a quote from the S&P Global U.S. Services Sector Survey that was also released. And here's from that report. The survey data are providing a timely signal that the health of the U.S. economy is deteriorating at a market rate, with malaise spreading across the economy to encompass both manufacturing and services in November. So go figure. I just read from the ISM report that said stronger business activity, increased employment, and so forth. And then literally on the same day, capturing the same month, you hear that malaise is spreading across the economy. So what gives? Well, different questions, maybe some different sector mixes in these two surveys. But the title of my blog post Wednesday when I wrote about this is Never Cut and Dried. And essentially what I said is let's just call it confusion over what to expect heading into 2023. Taking a quick look at Citi's U.S. Economic Surprise Index, it's actually remained in the positive ever since it broke above the negative line here back in September, and it stayed there. So what this says, folks, is that the data is coming in a little better here, just a little bit, than what economists have been forecasting. So that tells you that economists are getting pretty bearish on the economy going into next year, and the data quite isn't supporting their bearishness, at least not lately. The PPI number came out this morning, and again, wrote about that in the pre-market. The minute it came out, S&P futures went from up 50 bips to down 70 bips, and they've been kind of hugging the flat line most of the morning since then. So as you can see, inflation continues to come off the boil, right? This is the headline number, right, on a year-over-year basis, 7.4%, and kind of flat on a month-over-month basis at 0.3. On a core basis, which excludes food and energy, you can see just a slight downtick to 8.0. Don't have the monthly dialed up, but it came in at 0.4%, which was twice what was expected at 0.2%. So relative to expectations, even though PPI came down a little bit, it really disappointed, and that's got the market a bit skittish here. As I speak, the S&P is pretty flat, down 9 bips, but the VIX, the volatility index, is actually up 1%, which suggests there's some, a little bit of angst or fear or some hedging going on under the surface right here. Copper, pardon the confusing looking chart here, but just disregard my annotations there. I still find copper very correlated to activity in China, and you can see we've seen a nice ramp here. Haven't seen that in all commodities. We've seen oil ironically going in the other direction, kind of discounting inflation and not really discounting how robustly bullish a China reopening would be for oil, but certainly showing it here in copper as the world anticipates China to take effort to catch up going into 2023 in terms of economic growth. Technically speaking, you can see the MACD down here. It just flashed a buy signal, and as right in here, yeah, if you try hard enough, you can say you had some bullish divergences going on there. So not a bad look for copper. As you know, we're pretty bullish copper over the long run. Sectors relative to the S&P, we just tracked a 30-day look back on this. So tech is slightly outperforming the S&P. 100 would be a match. Above 100 is outperformance. Below 100 is underperformance. Financials notably underperforming the S&P. Consumer discretionary underperforming the S&P. Materials performing with the S&P. Energy significantly underperforming the S&P, industrials with the S&P, but the defensive sectors significantly outperforming the S&P, and this speaks to the growing recession risk out there, and that's staples, utilities, and healthcare. And then lastly, for the economic look, this is one of the market indicators that we have in our index, and this is the ratio between TLT, which is the long-term bond, and the S&P 500. When it goes up, the S&P 500 is outperforming bonds. When it rolls over, it's underperforming bonds, or bonds are outperforming stocks. And you can see going into the Great Recession, the look there, you can see around these corrections in 2011-12, the European debt crisis, and then the corrections here in 2015-16, and actually going into the big COVID break here. And this was stuff we were looking at, as our index turned into the red before this happened. And so, as you can see, stocks have been doing well relative to bonds, and we can get into the weeds of the Fed and its influence on bonds and so forth. But lately, as you can see, this ratio of stock outperformance is trying to break through this pretty established trend line right here. So that also, one might say, speaks to recession risk. That would be yields coming down, bond prices rising to a greater extent than stocks are rising, or stock could be falling during that period. And that would suggest stocks may be finally beginning to discount something other than just rising inflation, and that would be the lower earnings that come from recessionary conditions, possibly going into next year. I think it's early. I still see the market trading up on bad news, but this would be essentially a hint that maybe we're on the verge of the market starting to trade poorly on bad news. Time will tell. Okay, so let's just, because I want to pull in bonds and the dollar, let's just do a quick look at the daily S&P and the hourly. So on the daily, not much has changed since a couple days ago when we looked at it. We were checking it out right in here. Remember, we broke down through this uptrend line off the bottom with momentum. Not a good sign. And what's really not a good sign is losing the 20-day moving average. Remember, we went through this on the last video. And if that thing is starting to peak and begins to roll over, a lot of evidence, at least this year, the way things are trading, that is not a good look for the stock market. The 200-day moving average is still sloping down, and we came right up and just kissed the downtrend line and fell right off of that. Okay. The other thing that we look like we really have going on here on the daily chart is a real classic looking bear flag pattern. So if that were to play itself out, that would happen. That would need to happen next week, and then you go down the length of the flagpole, and suddenly we're back down here at 3,800. And I think if we do that in December, I think that could be quite the area of short-term support for the market. We could get a good bounce off of there. Next week's going to be interesting. We have CPI, we have the Fed meeting, and then we have the biggest options expiration of the year, December 16th. So, and we're still in a stretch of the year that's typically really good for seasonality. So it makes sense to me that dips get bought. Last night's log entry, which I shared with you today, I intimated that right now I'd be surprised if we got some big bear market washout in December, which is our base case, at least right now, based on the world as we see it, always subject to change for sometime, in the first half of next year, but probably not in December. And when I say probably, that's what probabilities point to based on our technical and fundamental analysis on a short-term basis right here. And then on the hourly, so remember we drew this long rising wedge pattern right here, broke down below that, and remember we have bearish divergences down below. I'll show you those in a second. And looks like we're establishing right here, or trying to, a new trend line right here that we're just boom, bouncing up, bouncing against, and so forth. So, I don't know, it could be some swing trading opportunities if we're right about December maybe not being horrible before it's all said and done. Be interesting to see if this trend line, which is a pretty solid trend line on the hourly chart, proves as some resistance if indeed we break up above there. Ultimately, if we break below there, remember I drew this line and I've been dead wrong so far. I really thought we'd come back and test that. That's a few Thursdays ago. Actually, the last CPI print where the market just shot through the roof. It'd be ironic if next week's CPI print does the opposite and we go down and finally fill that gap. If we're right about probabilities first half of next year, well then of course that ultimately does get filled, and something more so to the downside. But again, that's all remains to be seen. What I love about markets is they're dynamic and humbling. And I do mean I love it. It's a good thing to be inspired to stay deep in the weeds, dig through the data, and never take anything for granted. And then, as you can see here, again, we We had that rising wedge. I said odds favored something lower. That's what happened. We broke out of that. Now we caught this new trend line, but look what's happening here. These aren't divergences because it's going with price, but that's a buy signal, right? And it's not negative right here. So this is that ambiguous look. So what about other asset classes? Are there any clues that we can gather from there? Well, one thing that's been pretty clear, particularly of late, and that is the negative correlation between stocks and the dollar. So here's our dollar index, which, as you can see, we work on pretty hard because it's very important to get a feel for where the dollar is going. Pretty convincing bear flag here that is playing out so far, right? And that's probably about the length of the flagpole there. I don't know that we go that far down. In fact, I'm going to show you a technical look here that says we're not going to. And I'll fold in the S&P here so you can get a feel for what I'm talking about. So here's the S&P 500 index this year. So here you see, the dollar, trending higher, the market trending lower. Not a perfect match, right? Here they're just kind of, a little bit of back and forth here. You can see the S&P actually going down with the dollar. And then the dollar kind of taking off. The S&P finding other reasons to trade here. And then as the dollar really ramped up off of this bottom, S&P went in exactly a different direction. As the dollar peaked, right, S&P bottomed. And here we are so far. As we broke down, stocks have seen a nice rally. And that's that October rally. So that good seasonality also coincided with a falling dollar. Okay, so now here we have the dollar in a bullish falling wedge that it tried to break out of and failed here so far with bullish divergences. So you see you have a lower low, but you have a higher low on the MACD, and that's a buy signal right there. And a bit of a higher low or maybe flat here on the RSI, but by definition, that would be a bullish divergence as well. So if this plays out, that would have the dollar going higher. And if the correlation continues, that would have stocks going lower. Now, if that begins to play out over the next few weeks and months, well, then that supports our bearish feel for the first part of next year for stocks. And then our proxy for our purposes here would be TLT, the 20-plus year Treasury bond exchange traded fund. That's the price here. Here's the MACD and the RSI. So here we have a rising wedge pattern in treasuries. We don't have divergences necessarily, but we do have the most overbought on the RSI than we've been all year. So we have not seen that kind of a ramp in bonds. As we got close here, that was right here. And yeah, that's about it. So you notice when we got way oversold right here, we had this really nice rally right off of the bottom. And you do have the MACD showing early signs of rolling it over. So that'll be interesting to see if indeed bonds don't begin to roll over here some. And why would we be concerned about that if we're equity investors? Well, it's because of the correlation this year. So the blue line is the S&P 500. And as you can see, definitely even more of a correlation compared to the dollar and stocks. So there's bond prices falling, and that means interest rates rising, and there's the stock market going with it. There's when bonds bottomed and interest rates began to fall. There's bonds falling and interest rates rising, and here are bonds rising and interest rates falling, but you've got a bearish look there, kind of beginning to break below that. So that suggests that interest rates may spike here. That's happening today. We had that higher than expected PPI, plus bonds are very technically overbought. So when you look at the dollar lately, technically, and you look at bonds, technically, well, then you would say technically, there may be a downside edge here to stocks going into next week. But it's nothing that I would trade right here. I would not get excited about it. If you're a short-term trader, you look to these videos for some sort of insight. I don't think I'm giving you much, but if I had to lean in one direction, only based on the technicals, not necessarily based on what I think is going to happen next week in terms of CPI and the Fed and so forth, but only based on the technicals, it would say that if you had to take a position, you'd want to go slightly to the short side, but you'd be bucking seasonality. We get into January, and I think we're going to be having a whole different conversation about probabilities and what we see for the market for the first few weeks and months of next year. I'll leave it there. Folks, thank you once again, as always, for watching and listening. I'll be back Monday with our morning note. Take care. Bye-bye.